Welcome back to another episode of the Market Noise podcast on the Financial Autonomy podcast channel. Welcome to everyone that's checking us out on YouTube, but of course, aware that most people, it's the audio version, the podcast version, and so wonderful to have you on board. And this week, this is the last Market Noise for the year. The normal Financial Autonomy Wednesday podcast will be happening all the way through Christmas, all through January, so plenty of good content for you there. But Market Noise, this is our final week. And we're finishing on a real high because today, as you guys know, I've been rotating the co-host for a little while. And today I'm really excited because we've got Pat Garrett on the line. Pat is CEO and co-founder of SixPark. And for those of you, if you're getting the Gaining Choice weekly email, of course, every week we have a link there to SixPark's Goal Explorer tool, which is excellent. And we also have that linked on the website as well. So SixPark is our digital advice partner for clients where the financial autonomy program doesn't quite fit. Then we go to the SixPark solution, and we find them great partners to work with. So very excited to have Pat on the call. Pat, thanks for giving us some of your time.
Great to be here, Paul. The feeling's mutual. I've been looking forward to this for a while.
Now, Pat, we should just dazzle people a little bit with your background because it's pretty impressive. Do you want to tell us a bit about your career background so they really understand what a heavy hitter we've got on the call here?
Yeah, I'm not sure dazzling is the right word, Paul, but as the listeners or viewers will probably gather, I'm not from Australia. I'm actually from the U.S. I moved here about 21 years ago for 1 or 2 years. But my background is engineering and commerce in the States. And then 10 years at JP Morgan in New York in mergers and acquisitions and corporate finance, and then ultimately in the private equity business of JP Morgan, which was growing, and this is in the mid-90s. And I was really fortunate to work at the time for the gentleman who was tasked with growing that business. His name's Brian Watson, who's originally from South Melbourne. And after 10 years in New York City, I had enough of the Big Apple. It was exciting, and I learned a lot and had some amazing experiences, but I was ready to take a bit of a breather. And at about that time, Brian moved his family back to Australia because he had 4 children born in Brooklyn Heights. And he lured me over to continue working for him, which I thought was going to be a year or two. That was 20 some years ago, but we worked in private equity and venture capital for a number of years. But we always had a desire and a passion to set up a business, having been involved in investing in other people's ideas and providing some capital and thought to help them grow theirs. We kind of wanted to do one of our own at one point, and that idea hit us a few years ago in building a digital advice. Advice being a key word in that, a digital advice service, regrettably labeled robo-advice, but which in short just asks consumers questions about risk and their situation, and then makes a recommendation about a portfolio of growth and defensive ETFs, and then manages that on an ongoing basis. So probably a little later in life than normal to get into startup land, but it's been a lot of fun.
But you come at it from a great background and I guess a position of strength, presumably. And we've managed to recruit you to Australia, even though it was supposed to be a year or two, and here you are 21 years later. So
no, it's a good place, Australia. I enjoy it. If you think about what's going on in the US right now, it's not a bad alternative.
And certainly a good time of year to be in Australia too. Nice and warm rather than freezing over there. All right. Well, look, we need to get into the normal market noise stuff. Before I do, obviously, you guys, regular listeners, would know we always have the general advice warning. Clearly, Pat nor I, we're not giving you any advice. We don't know anything about your circumstances. This is hopefully interesting and a bit of fun. But please, if you would like advice, then check out the Financial Autonomy website, the advice page. We've got all the details there, and whether we can solve you in terms of the Financial Autonomy program or indeed the SixPark solution. We've certainly got your advice needs covered. All right, well, let's jump into topics of the week, and there was plenty of them. It was a little hard to pare them back a little bit, Pat, but first one I had was Jerome Powell, your countryman of birth at least, observing that it's time that we stopped using the word transitory to describe inflation. He said we tend to use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's a good time to retire that word and try to explain more clearly what we mean. And this was sort of in the context, well, it was an interesting tack on because he also mentioned in the same piece about we announced that we were going to ease back on tapering. Maybe we might even bring that forward, which is not necessarily the same thing as saying that we're going to get rid of transitory, but it's kind of hinting in the same direction. What did you make of those comments, Pat?
Well, I think he recognized that markets were getting a bit fixated on inflation remaining prospectively at historically low and arguably unsustainably low levels, and that a rise in inflation is not necessarily a bad thing. Obviously, a precipitous, prolonged, unexpected shock to the inflation environment is not a good thing. But a steady rise in inflation above what are historically low levels. If you look at the chart of inflation over time, I mean, we are truly low levels. So I think he was just trying to neutralize a little bit this focus on the word transitory, because the market got so riled up when the scepter of inflation rose. I think he wanted to just try to nip that one in the bud a little bit. He could also see that if he didn't say something like that, he was probably going to get pegged.
I mean, the funny thing I thought, though, is he's the one that created transitory. It only became part of the language and part of the narrative because he put it out there in the first place. And now he's reeling it back in. I mean, I just thought that was quite amusing.
Well, gone are the days where people like the Fed chairman get up and, for the most part, tell it like it is and use the words that we're all used to. It is obviously there's an element of politics that's been inserted into what the Fed does or doesn't do. And so I don't think I've ever observed a body so careful with every single word it uses, because it moves global markets if it has the word relatively, in a sentence. That can change, the entire landscape of markets. So, unfortunately, the way it works now is they have to be really careful in the words they use. But I think fundamentally, he was just trying to recognize that thinking that inflation going up is a bad thing, full stop. I think he felt he needed to say something about that.
It's too simplistic. Yeah. And it is interesting thinking through the winners and the losers of inflation, because, as you say, there are actually, other than any really extreme events, but just let's put that to one side, there are plenty of winners, most particularly people with a lot of debt. As long as interest rates don't go berserk, then your debt gets progressively easier to pay off. The ones that get, and probably even more importantly, people with real assets, whether they're equities or property. I mean, the people that get hurt are the people with savings in the bank, but actually there's a lot of winners. I mean, so long as wages keep pace, which they probably will. You
just touched on, I think, Paul, definitely in Australia and to some extent in the US. What isn't spoken about as much, because there's reasons they don't want to put their finger too much on it, is that wage growth is actually one of the main objectives that doesn't quite get the airtime as a target. The Reserve Bank isn't going to say, all this other stuff is kind of noise. We're really focused on wage growth because that's what will make people happy. But I do think wage growth is actually one of the more critical components of what's watched. And if inflation is managed or happens, in a way that isn't too destructive, one would expect wage growth to align with that, and that's not a bad thing. As well as corporations will, typically be able to, inflation's rising, costs are pricing and whatnot, and wages, hopefully. Corporations can improve profitability through increased prices, and there's pros and cons to it, but it's not all bad.
No, and I mean the other element, the reason you want inflation as opposed to deflation is it's an incentive to get on and get stuff done.
Yeah.
Because if you delay, well, it's only going to be more expensive 2 or 3 years from now due to inflation. So it's a nice protector against inertia and against procrastination, which kind of helps. I mean, I sometimes wonder, in the US Fed, their target, it's 1% to 2%, whereas here it's 2 to 3%. Do you actually think the 1 to 2 is too lean? Like, is that keeping it too low?
I think it probably is, Paul. And I think what's happened is we're not surprisingly coming. Well, we're not coming out of. We are still in what I would call the relatively early days of an era of technology-driven efficiencies in the U.S. relative to Australia, the decreased influence of unions, and a variety of other things that will have, on balance, a downward impact on what inflation will trend to. Okay. And so I think the lower expectations reflect that, but I'm just not sure it's sustainable at those levels, because I think at some point, growth, we're getting into a bigger kind of conversation. If you try to wrap in GDP growth and wage growth and inflation, there are very complex relationships amongst all those things. But 1% to 2% to me does feel like it's lower than it needs to be.
Yeah, it doesn't give a lot of room. Yeah, if you're hitting the brakes at 2%, that doesn't give you a lot of room to run, does it? But
no. But all the rule books are sort of out the window right now with what's been happening in terms of monetary and fiscal policy.
Yeah, that's true. It's a different world. I mean, I have a chart pack we go through with clients when we're doing annual progress meetings, and one of them is some data. I think it came out of the Reserve Bank chart pack that Australians are wealthier than they've ever been. Now, which is not surprising because the share market's up and the property market's up, but it is surprising that that's where we end up after a global pandemic and our first recession in over 25 years. The culmination of that is that Australians as citizens are wealthier than they've ever been. I mean, how did that happen? But as you say, it's in a new world, isn't it?
Yeah, it is, and I think it really amplifies the need for investors, new and experienced, to recognize that investing's as much sort of an emotional and perception game as it is a numbers game. We talked a little bit before this about how recent entrants to the markets are probably thinking to themselves, "This is a reasonably easy caper. We've been through a pandemic, and I've made 20-some% on my port, if not more, depending on what you invested in." But markets are cycles, as you know. You've been doing this for a little while. Cycles. There is a cyclicality to what we're going through, and I think we've got. It's easy and understandable to be focusing on what's happened over the last 2-3 years because of how unusual it is, but that's a pretty short time frame in the grand scheme of investing.
Yep, fair observation. All right, look, how about we move on to the next topic, number 2 there. Over to you, Pat.
Which one do we have here? This is the Omicron.
Yeah, what did you want to go there?
Is there a potential good outcome here? There was some interesting. We had an investment committee meeting last week, and not surprising, on the heels of Omicron surfacing, and I'm assuming the audience is aware that this is the recent variant of the COVID virus that is spreading rapidly, and therefore a legitimate cause for serious concern. But there's 2 really, really important data points in thinking about Omicron that are as of our discussion now, unless I'm mistaken, unknown, which is how sick does it make people, and how efficacious or not are the current vaccines against this variant. And I think absent that information, it's a bit of a finger to the wind as to how bad this is. The question that kind of came up, or the one I sort of put out there that I thought hasn't really been talked a lot about. We're hearing a lot about how bad this could get. I actually think even from kind of a markets perspective, and I'm not saying I think this is going to happen. I'm just saying it's not out of the realm of possibilities. If it turns out that this is a rapidly spreading variant that doesn't actually make people very sick, and the development of either new or the existing vaccines actually can help control the spread, it's entirely possible that the market will have a bit of a euphoric response to this kind of shuddering panic that it had the other day. I think it's all still to play out, but I found it interesting that the markets, and it's just symptomatic of the volatility we're in now, right? Global markets were down 2% on a Friday, up 1.5% the next day, down 1% the next day, up 1% the next day. I think that's the world we live in now. But I guess what I was throwing out there, interested in your thoughts, if it was, there is the prospect that this is, we're not even talking about this in 3 or 4 weeks.
Yeah, and there's a couple of ways it could go, right? So yeah, one is, as you said, the potential, which is what we're all hoping for, that actually it's not a particularly deadly variant, and therefore the world moves on, and there's some talk that maybe even it's helpful in terms of building up immunity in people that haven't been vaccinated.
Right.
So there's that potential upside, which you're right, you could easily envisage a relief rally off the back of that news, even though actually the market hasn't dropped that much. So it's not like it should be the case that it drops and then you have a relief rally to pick up what you just lost. But actually, it wouldn't at all surprise if it went well beyond that, because not that much has been given up. But the other way you could flip it, and you sometimes see this in markets where you get good news is negatively impacts markets and bad news positively impacts markets, right? You could get a situation where markets go, well, this is good. They're not going to taper as quick as we thought. Interest rates are going to stay longer forever. There's going to be more stimulus. So I think there's potential to spin it positively in either direction, actually. And it's kind of almost just the will of the market as to which way they choose to run with it. But yeah, you could take a positive spin both ways.
I always get a kick out of seeing, and it seems like it's about every 2 weeks these days, looking at the front page of a business paper, and in one section it'll say strong employment numbers to put downward pressure on stock markets because of A, B, and C. Here go to the bottom right. It says strong employment numbers support increased valuation and growth in the market. And they're both right? They're both just sort of theoretical what ifs. But it's, to your point, Paul, it just I think amplifies the need to have a bit more of a macro view of the world, and particularly the time frame of investments.
Yeah, that's it. That's the long-term time frame, isn't it? All right. Well, look, the next one I had, and keen to get your take on this one, Pat. It was a piece in the Fin Review, and it talked about the debt bomb, which is obviously an evocative type headline, clickbait-ish, which, hey, that's what they're there for. But it touches on the fact that interest payments on 1.3 trillion in state and federal government debt will grow to 34 billion by the year 2024-25 as Australia's strong economic bounce back reduces debt but pushes interest rates higher. Now, it's always a bit hard to get a sense of, trillions and billions in a national context. It's hard to kind of get the sense of what's the real magnitude of that. But it certainly has occurred to me through this period, at least, I don't know, to me, it's more noticeable at the state level. They have done a lot through coronavirus to support small businesses in particular. There's been lots of handouts. Presumably there must have been less GST take. I'm not sure on that, but I just would have thought with all the shops shut, that would seem logical. So I do wonder a little bit about the balance sheets of the states and the Fed, and kind of how that shapes up, and how do we have some sort of hangover from all this for the next decade as we try and pay this all back? And so that one just caught my attention a little bit. What do you make of that, Pat?
Yeah, it's I think it's a really interesting one, Paul. I have the good fortune of having, and Six Park does, an investment committee that includes Mark Nicholson, who was one of the co-chief investment officers of the World Bank, and So I get to hear his views of the world, as well as Lindsay Tanner and Brian Watson, the co-founder. And it's a really fascinating discussion when the committee gets together every 2 months or more frequently, because Lindsay's got sort of a geopolitical dimension, being the ex-finance minister, Mark being having more of a debt background, which is the reason I'm mentioning this, and Brian with a bit more of the equity market lens. So when this topic came up, it was really this specific topic came up that you raised, Paul. This was maybe a few meetings ago, and the deliberations of the investment committee were focused a bit more on kind of near-term events at the time. And I found it really interesting that one of the comments, and I think it was from Mark, but and I'll mangle it a little bit, but it was sort of along the lines of, I think the things we're worrying about now could materialize, but there's lots of reason to think they may or may not. What was a worry was, what is the risk in 2 or 3 years when some of the the bills are due, so to speak, that you're referring to.
Yep.
And what are the global ramifications of if some of the assumptions underlying the various entities, governments, municipalities, and whatnot, to pay back interest payments and principal, if some of those assumptions don't play out reasonably well, there's a reasonable case that there is a substantial global recession, right? That's that with different dimensions to it.
Yep.
And so that was, I thought, very interesting to your point of it being like a pretty serious thing to be thinking about. But then we realize anything that we're talking about that's 2 or 3 years off, you just sort of then put in the shelf and say we can't do anything about that now, right? Because it's just too hard. 2 or 3 years in terms of the prediction window is a tough one.
Yeah.
But okay. I think a point you raise is in the back of mind of a lot of really smart people to be looking for the early warning signs of how that might manifest in financial strain within the system, the global economy.
And the knock on to that, to some extent, is inflation is helpful.
Yeah, exactly.
So if governments have racked up this debt, maybe they're a little more positive on a bit of inflation floating around because it makes it easier to get rid of it.
Yeah.
Yeah. Okay. Good-o. All right. Your turn, Pat. What do you got there? Thematic active ETFs.
Yeah. So it's one of the fastest growing and most talked about segments of the exchange traded fund market, both in Australia and in Europe and the US, has been sort of the thematic or active ETFs. And correct me if I'm wrong, Paul, but I'm assuming most of the audience here will understand, the basic mechanics of the wrapper of what an exchange traded fund is and tracking an index and whatnot.
Yeah, and you got a well-educated, intelligent audience.
Yeah, I assume that's the case. You've done your job well there. And so I'm sure they're probably also aware that the active and thematic ETFs are a natural progression of a product that gets a little bit more innovative, is one way to look at it, and also targeted and specialized. And it starts to get obviously a bit away from the original ETF products that were tracking very well understood indices of the S&P 500 or a global bond index or whatever it might be, ASX 200. And they really had have had a shining moment during a pocket of time around the onset of the pandemic and the recovery around the pandemic, driven in part by a really big increase in the number of retail investors getting into the market and wanting to find themes or big global macro trends that are really forward thinking and the future and whatnot. And so a lot of money has flown into those thematic ETFs or the active ETFs that tend to take a bit more of a prescriptive filter that that may sacrifice a little bit of the transparency, all of which, just to be perfectly blunt about it, are for the most part marketing campaigns of the issuers. I'll just say that, probably piss off a few of the product providers we use. But the reality is they are, part catering to an investing audience that wants new products, and part marketing to get assets under management. It worries me a little bit because there is, if we won't unpack entirely behavioral finance, but I'm sure you cover a bit of that in some of the discussions you've had. But the concept of FOMO and following the herd and anchoring and other behavioral tendencies that are detrimental to investors. These products, a lot of these products, and I'll mention some of the data to support this comment, but a lot of these products play into that human behavior and emotion, and don't necessarily end up being a good outcome for the investors. So I'll use some examples. In Australia, there's ETFs that track companies that are in the robotics industry on the basis that that's part of the future, that track electronic sports and gaming companies because people are sitting at home playing games more. Crypto is one that is upon us now, obviously. And what a lot of data from the likes of Morningstar and other pretty reputable entities shows is that short-term track records for a lot of these thematic or active ETFs have windows where their performance is phenomenally good. In my view, because there tends to be a herd mentality where money piles into them and popularity breeds out performance. But everything that I've read about the medium to long-term performance is that they underperform the broader global equity indices. And so I'm not a big fan, I guess is what I'm getting at.
Yeah, I'm getting that.
I'm not a big fan, generally speaking. I am all for investors taking, as you might guess, taking control of their engagement with their financial matters, getting involved in investing, learning about investing, having a punt. I have nothing against crypto investing as long as you don't bet the ranch on it. I have nothing against utilizing some of these thematic, if you're interested in it, if it stimulates your brain, if you like watching it, if it keeps you engaged. But I guess I have a measure of caution because I've seen both personally and professionally people, they typically get in too late, right? There's a massive run up in a certain sector. So an ETF gets issued, at a high point in a cycle. Retail money, which a lot of the institutions would say dumb money, which is a horrible moniker, piles in, and then it loses its luster, and people go, "How did that happen?" And I'll just generalize the heck out of something, but it has played out a bit. So I guess the reason I put it on the list of things to talk about, Paul, was just to just highlight, I think, the need for people in any investing to, do the homework, have conviction that it's not a trend. It is actually, if it's a thematic or there have been some spectacular flameouts on the active ETFs that, attractive on the surface, but the rules or filters actually are flawed. And so anyway, I'll sort of stop there. It's buyer beware with those things and do your homework like any investment.
I guess also it fits into potentially a core satellite approach, which is something on the Wednesday podcast. We've covered quite a bit, but typically, if we used any of those thematics in our clients' portfolios, they would be as satellites, right? So you've got your core as your traditional index type passive exposure, and having those thematic. The active ETFs, I struggle to get my head around a little bit, but anyway, maybe I'll come around. But the thematics there are some that I think are interesting. I mean, we've seen a lot of the ethical ones, of course. There are a lot of people feel very strongly about that, and the performance generally has been quite good over an extended period. But I hear where you're coming from around things like esports, which I must admit I had a little crack at that for a little while, but I think I've sold that off now. It didn't do anything for me. Yeah, I mean, they're interesting, but I hear where you're coming from, and yeah, I've certainly seen some research that kind of points the same way. But it can be an interesting way to get a position, and particularly that ethical, or people. I find people that are concerned about the environment and global warming and some of those type of issues, and they want to have their portfolio reflect that. And I know that you guys at Six Park have the ability for people to reflect that as well.
Yeah.
Then using ETFs that apply those kind of filters does deliver on that. And the performance of those, the problem is the performance is quite diverse depending on which one you use, but so generally the performance seems quite solid.
It's a really fair point. Paul, that on the ESG sustainable ETFs or just even managed funds, I probably came across as sort of bashing all of them. I'll give you an example. There's some, a healthcare ETF. If you're in the industry and you know that industry and you think I want to make an investment that's in line with, something I know, I think that's a great idea. Huge fan of the core satellite that you mentioned. I guess what I was getting at more is to try to be a bit proactive and draw on a line where there's a difference between something that has strong foundational anchoring, like I do think sustainability, I would say, is a trend that has longevity to it.
ESG, rather than just flavor of the month stuff.
It'll have its moments up and down, but you're right. It's not. I don't think that one's a flavor of the month. That is where the world's headed, right?
Yeah.
So anyway, it's I think a fair point.
No, good observation. Hey, I've got a little bit of a fun one here for you, but as a CEO, I'm interested in your take. How would you feel if you were the founder of a business that is incredibly influential? In fact, has been the microphone for former US presidents, quite all around the place. And so you're the founder, or at least the co-founder. You've been the CEO for, I don't know, 7-8 years, pretty long time. You announce that you're going to step down as CEO, and the share price goes up 12%. How would you feel, Pat?
I'd probably internally not feel great and externally say, look what I just did for my shareholders.
Of which you're probably a significant one, I guess.
Yeah.
If you're the co-founder and CEO, you've probably got a bucket load of shares. So I guess you're
presumably talking about Twitter and
we are talking about Twitter and Jack Dorsey. We are, yes.
Yeah. It's an interesting one. I read Barry Ritholtz and Josh Brown in the US are two commentators that I like to listen to their podcasts and read their stuff. And they put out provocative, but I think really well thought out pieces of podcasts and whatnot. Anyway, one of the recent pieces was an argument that Twitter is arguably one of the worst stocks you could have ever owned ever in your life. And I thought that's interesting. I read a little bit of the article, then I looked at the charts and saw, it's about the same price it was like 12 years ago. And it's obviously fluctuated around a lot, but
the market cap's increased, but I think they've just issued a lot of shares.
Yeah, exactly. And I didn't realize it because I don't, we use broad-based indexes. So I don't spend lots of times, a lot of time analyzing company specific stuff, but I didn't realize till this came up that I had a look and by most of the key metrics of a company that does what Twitter does, they haven't been performing well. Their subscriber bases numbers have been underwhelming. They haven't innovated. I hate to say, use Facebook Meta as a comparison in a positive way, because I don't always like what they do either, but they certainly have learned how to monetize and grow the business in ways that Twitter's just lost a step. So, and he's also obviously running Square.
That's right. It's a part-timer.
Which I guess has a new name, Block now. Is that right? We're getting that right?
Like that. I saw it changed its name, but
anyway,
I'm not sure what.
One of those one of those characters who's a luminary and an oracle in a sort, in some ways, at what he does. But I think the market was sort of ready for him to move on. As entertaining and respected and admired as he is in many ways, I think that was just a situation where any major news was going to move that stocks one way or the other. But in his instance, it probably wasn't the way he wanted.
No. All right, that was a bit of fun. Hey, another one that I wanted interested to get your thoughts. So we talked about thematic ETF. So this is very much related in the crypto space. Now, at the moment in Australia, there's a thematic ETF, but it's around crypto, but it's the periphery. It's businesses that are involved in crypto. It's not actually the one that everyone wants, which is an ETF with Bitcoin or Ethereum or something like that. But by all accounts, it's pretty close. ASIC's sort of given some direction, and there's a few players that are saying that they've lodged their applications, and presumably early in the new year. I don't imagine they'd want to launch in December, but presumably early in the new year, they'll be available to investors. And I guess also just within the context of, we saw a pretty sharp drop in crypto over the weekend, actually, which who knows, that's just crypto doing its thing, I suppose. But I mean, you've sort of, you've given your position on thematic ETFs, so maybe you've already answered the question. But ETF, when ETFs arrive on crypto, I mean, most obviously Bitcoin and perhaps Ethereum. What are your thoughts, and can you see them ever being added into six-pack portfolios, for instance, or your personal? How do you see them playing out?
Yeah, I will. I won't be quite as ruthless as I might have sounded earlier. I actually think that there's zero doubt that the investing world wants to be able to invest in crypto assets, and I don't, as speculative as I might think that is, and the commensurate amount of volatility. Obviously, people, some investors have made a lot of money investing in crypto, and whether it's crypto or the underlying blockchain and bricks and mortars and whatnot, and shovels and picks, I guess people call it. I can't deny that is an asset class that there's a lot of demand for, and that probably isn't going to go away. I think there's too much evidence that it's not a passing fad. I'm not saying it's going to be wildly successful and all whatnot, because I don't envision Six Park having it as an asset class in our portfolio anytime soon, because we will really only deploy assets where we have a good understanding of the risk reward profile. That doesn't necessarily mean low risk. It just means an understanding of the risk reward profile, and I don't think there's just enough in the crypto space to kind of pass that filter on our end. That said, this is a good example, Paul, I think, of the core satellite that we talked about before, which is, I think, when it comes to, say, fads or trends that you can sort of look at from the sidelines and say, that sort of sounds opportunistic in terms of, say, maybe a fund theme or whatnot, and that's kind of what I was referring to before. Whereas I will capitulate and say, I think in the crypto space, it's not going anywhere anytime soon. So if investors want to get some exposure to that, and they understand the volatility dimension to it, that's a core satellite component that I would, because we get asked all the time at Six Park, do you have crypto in your portfolios? Can I pick a crypto, somehow layer crypto into a Six Park portfolio? And our response to that is no, not today, and we explain why. But if you want to have exposure to a crypto asset, and you believe and you recognize that you might make tremendous returns, but it's going to be most likely going to be a pretty wild ride. Think about core satellite hub spoke. And that resonates really well with people, because it's not just crypto. There's a whole slew of things that are a lot more speculative, or as speculative. And if you can surround a boring but beautiful portfolio with those kind of things, then you kind of get the best of both worlds because people want to, you know, have a punt on things.
I think where it's, yeah, so definitely I would imagine the use case being as a satellite holding, maximum 5% of the portfolio, but maybe 2. But anyway, somewhere in there, satellite holding. But I think what's interesting and what I've been trying to get my head around, and we've talked about it a little bit in past episodes, is around the correlation between crypto and equity markets. Because in trying to construct a portfolio, you're trying to get asset, you know, it's always diversification. Diversification reduces your risk. In order for that to be the case, then you need low correlation, trying to get correlation around 0, getting a little bit jargony, but that's really hard to find because actually, like, okay, we diversify Aussie equities and international equities, which is usually the starting point, right? But actually the correlation between those two is pretty tight. I mean, it's certainly not inverse. You know, they're heading in the same direction, and it's really just the magnitude. It's really hard to actually get genuine diversifiers in the portfolio. And so to me, where it maybe has an application, where I'm interested, and it'll be interesting to see how the data flows, is that could this be an asset class that we could have as a satellite that is genuinely uncorrelated to equity markets? And as you say, it's volatile, but that's fine if it gives us some diversification benefits. And if the data that I'm seeing so far, it seems that way, but it depends how you cut it, and it, you know, it's hard. We don't have enough time frame really. But have you sort of seen anything with that through that prism?
Well, I think a similar approach could be made. So we don't have gold in our portfolios.
Right.
And we studied the pros and cons of having gold in our diversified portfolios in great detail. And what we concluded was it is a diversifier. But we believe that the hedge against inflation and some of the other cases made for gold as holding in a diversified medium to long-term portfolio, as opposed to a tactical investment when you think things are going to go pear-shaped in the market, so to speak, that a non-income producing asset class whose correlation is debatable depending on what time frame you look at, is more of a drag on portfolios than additive. If I were going to have a 10% allocation to gold, I'd say, no, I don't want that. I want, you know, six to a growth asset and 4 to a defensive, because I know what that's likely to do, and it's going to generate income through market cycles.
You're right. And so the gold, like we've seen that. So I was just going to say the gold, you're really glad you've got gold in there 1 in 10 years, but the other 9 years, you wish you didn't have it. And
and I guess my point is, I think gold is not I'm not saying gold's a bad investment in the same way that I think you're arguably saying crypto isn't necessarily a bad investment, but you have to weigh it up against what other things can you use within a diversified portfolio. And that, I think, puts it into that satellite spoke realm as opposed to the core.
Good. Hey, Pat, I think we've got time for one more topic. And I see you had listed there, you wanted to have a chat about Robinhood. So I don't want to leave without doing that, because that's an interesting one. Do you want to fire that one away?
Yeah, I mean, my thought on that was obviously in the States, Robinhood, free brokerage, but as we all know, they make money on selling payments for order flow. So they're not a charity. And in Australia, some very good providers have now enabled Australians to invest not for $50, $75, $50, $40, $20. You can now invest for $3 to $5 in the market. Because of some of the not irregularities, but some of the dynamics around the ASX structure and pricing, it'll not likely to go to 0 in Australia. But I guess what I wanted to sort of just comment on was there was, in the meme stock dynamic, GameStop and whatnot was sort of the extreme illumination of this point. But there was this feeling like free trading was great by definition, full stop, end of story. The democratization of investing. And to be clear, accessibility and affordability is something we preach every day about, whether it's investing advice in our instance and investing. And so I don't think lower costs necessarily is a bad thing, but I also don't think it's sort of the end all be all, because these are business entities that need to make money to remain viable. So that whether it's the FX rate you're going to get, if it's low cost, free or low cost trading on foreign exchanges, you're probably paying a price somewhere. So what I find interesting is what I will find interesting, Paul, is the bank's still charging pretty high relative to some of the low cost offerings out there. I'll be really interested to see whether some of the incumbents' prices that are still in the $10 to $20, how they respond to some of the $3 and $5 options that are out there. Whether it's through Stake or Superhero or Self Wealth and some of these others that are out there. My hope is that the evolution of and certainly Robinhood's taking it a bit on the chin, and it will. And I think, and my guess is it will continue to take it on the chin as whether it's regulators or consumers not really wanting the gamification aspect, as they realize that investing is kind of a serious thing, not a game. That what we'll find in Australia, and we're seeing some of the grassroots of this, and we're seeing it through, and I say this genuinely, through working with people like yourselves, is that investing, that the transaction component is part of the broader element of financial literacy, of getting your house in order, of having a plan, of sticking to your plan, of having goals, and that just the lowest cost provider isn't the end all be all. And I think that's actually happening. I think the growth in influencers is it gets overused a little bit, but financial coaches and financial literacy programs. I like the fact that it seems like to some extent there's retail investors these days are buying ETFs now and not like trying to pick the next Afterpay or whatnot. So I'm seeing the early signs that people are actually, and millennials in particular, are actually taking a more prudent approach to how they think about investing. And lower cost is obviously, keeping costs low. We preach that every day. But I'm going on a little bit of a ramble here. I guess the Robinhood aspect was, it's been pretty fascinating to watch the emergence, the growth, the glorification, and prospectively kind of the breaking down of the Robinhood model in the US, and what are the learnings out of that for those of us in Australia?
It's interesting. I mean, that would almost hint that, heaven forbid, they floated at their peak. If you're saying that your sense is that model's breaking down, that they get the retail money in just when they've hit their peak. I mean, clearly, as you say, they benefited during the pandemic. People stuck at home, and a form of gambling almost, a bit of fun, and markets were going up, and therefore it's a nice sort of positive cycle of, hey, that worked out all right, so I'll do that again, and a sense of community perhaps as well, which is pretty important.
Well, it floated at 35, it went to 55, and it's now at 21.
Yeah, okay, boy, not one I follow, but gee, there you go. Yeah, so that's definitely breaking down. Yeah, well, as you say, there are low cost providers in Australia. I haven't seen any data. I mean, the cheap ones, do you know, are they getting much customer growth? Are they getting much growth in volume of trades?
Yeah, that they are, Paul. So the leaders out there, Perler, Stake, Self Wealth, Superhero. What encourages me is that, and it's sort of a generalization here, but I believe it. They all seem to recognize that a core component of what they need to do is educate consumers and protect them to some extent from. They obviously have a business mandate of trying to get people to sign up and trade. That's how they make money, and there's a commercial dimension to it. But it isn't quite the Wild West Robinhood putting off bells and whistles when you made a trade and whatnot. There's I guess my point was, to some extent, Robinhood's arguably done a lot of people a favor by showing, if it's done in a kind of a dangerous, flirtatious way, you can get harmed. Because as you know, and I'm sure you preach, investing's not easy. And just because you can do it in a more frictionless way doesn't necessarily mean you're going to make money and you're home and away. What I'm encouraged by is that a lot of the providers over here, they are trying to address, keeping costs as low as possible, and there's nothing but downward pressure on that. But there's actually a lot of work kind of building some of the scaffolding around education around that they are going out at mass scale, and their delivery model is different than, say, what you're doing, which is a more holistic approach, I think, to educating the broad financial wellness and literacy aspects of making the right, and particularly the behavioral aspect, which is frequently an underappreciated one, in which the training you're doing now with people, the real benefits in, let's just say, for the sake of argument, that next year there's a 6-month span where the markets crap themselves. It's the training now that really pays off in how to check the emotions.
Yeah, and I'm in the podcast world, I suppose, but I think podcasts generally, I think, have done a really good job of improving, as you say, just the fact that these days when people get into the market, very often the default is an ETF. And I'm sure that's not entirely due to podcasts, but I think it's a lot to do with podcasts, actually. And, all around the place. And the fact that is where people go, rather than taking a punt on an individual stock, far more likely then to get a positive outcome, and also a better going in with a more appropriate time frame as well, and that it isn't speculating. It's not like having a bet on the Melbourne Cup where we're putting money in here and that sort of stuff. So I think it is interesting, and I think the markets, people out there that are thinking about investing, the readily accessible way that through podcasts you can educate yourself and get good quality information, I think has really improved what's
massive.
Certainly in the people that I'm talking to, people are far more educated than they once were, and are far more realistic in risk and in time frame and those sort of things, which I think is fantastic. So definitely been some good steps there.
Yeah, I think the mediums and the channels that were once forums for some pretty wacky discussions, and they still exist, to be clear, but they've now been surrounded with podcasts like yours and others that realize that if you, Paul, as a person running a commercial enterprise, want to have longevity, the way you're going to do that is by building trust and engagement with your audience, not kind of the next shiny toy. Because ultimately this whole industry, and not to get too broad, but the financial services industry is a trust game. And if you can establish that by focusing on the fundamentals that we're talking about, then I think you've got an engaged audience for a long time.
Pat, I think we might close things out there. That was a nice way to round things out, both for this episode of Market Noise and also for this year of Market Noise. Thank you, everyone who has listened to us during the year, who's thrown in comments, who's given it a like, who's subscribed on the podcast. Really appreciate it. Market Noise, of course, was a new innovation that we added through the year. It's been a lot of fun to put together. I hope to bring it back in the new year, perhaps in February. Just wanted to say thank you for everyone who has supported the Market Noise program. But as I say, it's not that financial autonomy is stopping. The Wednesday podcast will continue all the way through Christmas and January. All right. Well, look, thanks again. Thanks for giving us some of your time. Thanks for listening. Thank you, Pat, for giving me your time and sharing that with the financial autonomy community. We'll see you all next time. Bye for now.